Hi everyone, this is Alex back talking to you about accounting. Today we're going to be talking about inventory. And when we talk about inventory, it's a good opportunity to also bring up the difference between financial accounting and managerial accounting. So in the first two videos, the topics we've discussed, they really go into what's known as financial accounting. And in financial accounting, the goal is to provide information about a company, financial information, that's going to be used by outsiders like investors, people trying to figure out if they should invest in a company. That's why they look at things like the balance sheet or the income statement or another financial statement. Whereas managerial accounting, it's the opposite. Managerial accounting is about providing information to insiders, like managers, right? So they know how their company is doing and what they can improve. And inventory and the related costs are a big part of that. So let's just dive right in. So as always, I start with the accounting equation here. Inventory is an asset, right? It's something you own that provides benefit to you. You can sell it and make a profit. Whether you are a manufacturer, so someone who makes their own inventory, starting with raw materials, or you're a merchandiser, someone who has inventory already and then resells them for a profit, this will be relevant. So starting with a T account here, right? Inventory is an asset, as we know. Increase it with a debit, decrease it with a credit. With T accounts, debits are always on the left, credits are on the right. So when you're dealing with inventory, this is where you'd start. So I mentioned the distinction between manufacturers and merchandisers or retailers. So let's start with the merchandisers. These are the businesses that they buy something already and then they resell it. So it's like it could be a middleman, right? They buy the finished product and they sell it at a higher price, and that's their business model. That's how they make a profit. So before they can sell it, they have to buy it. So let's say they have a wholesaler and say they purchased, we'll just call it inventory of 100. And if they bought it with cash, right, they would credit cash of 100. Say the beginning balance of inventory happens to be 0. So this would be represented by an increase on the left side of the inventory T account. Okay, so that's merchandisers. With manufacturers, it can be a lot more complicated. Right, so manufacturers, they're making the thing, whatever it is. Okay, this is where your intro to cost accounting or managerial accounting, this is where it begins, because what we have is, instead of just an inventory account, we have these terms: raw materials, WIP, which is short for work in process, and then you have FG, finished goods. So the idea is that managers want to see this kind of information. This is valuable to the insiders to see how they're controlling their costs, and you would actually have T accounts for raw materials, work in process, and finally finished goods, right? So these are all still assets, but they're like portions of the asset. It's not inventory yet, because this is a manufacturer. They have to make the thing. So here's a simple scenario for you. If you had you purchased 100 of raw materials, the raw materials, say they all get used up. Next step, is work in process, right? So they're being used. This is a process, right? In the manufacturing process, you start with materials, and depending on what's being made, whether it's a car or something a lot simpler, it goes through the manufacturing process. But these are the T accounts that are being used. So raw materials, you purchased 100, say you used all 100. Now you're at the second stage, work in process, and same thing. So notice I'm going from, right, I have a positive amount, oops, but then I'm decreasing it. And it's the same thing until finally you have your finished goods. Your finished goods inventory. Okay, so that's a little bit of managerial accounting, and that's the manufacturing process, the raw materials, work in process, finished goods in a nutshell. I just want to give you an introduction to that because I think it helps to understand this equation. Which will introduce you to cost of goods sold. Cost of goods sold is a very important concept that's it's a big part of understanding accounting for inventory. Okay. So whether we are in a manufacturer context or a merchandiser context, let's say we just have inventory now. Okay, so it's finished, it's ready to be sold. In the amount of $1,000. Okay, so this is the inventory you have. Throughout the year, you're either going to make more or you're going to purchase more in the case of a merchandiser. So let's call this purchases, and say we are in a merchandising context here. So just like back here earlier, you bought more inventory to ultimately sell, right, to another customer and make a profit. So say purchases of 500, right? So this is being added. You get an intermediate figure of 1,500. These are your goods available for sale. Okay. The next thing that we're trying to figure out ultimately is you have to go from goods being available for sale to actually being sold, right? And once you have that, you know how much you have left over. And this, we're going to reflect this in the journal entries as well. But there's two ways you can do it. You can have the next figure be either ending inventory, or you could have it be cost of goods sold. So let's say you know what the ending inventory amount is. And for those accounting students watching this video, sometimes you'll be given the ending inventory, sometimes you'll be given the cost of goods sold. But if you're given the ending inventory, then you know what the amount is of this term, COGS. So COGS, that's your cost of goods sold. Okay? So it could go either way. So it's, in a lot of books you'll see it this way, but it could be the opposite. It could also be that once you have your goods available for sale, 1,500, you could subtract your COGS, right? It's just the same thing. So your COGS now are 1,000, and your ending inventory is 500. Okay. So why are we talking about this? Because businesses need to keep track not only of what they purchase, but also what they sell, and ultimately their bottom line, their profit, right? So how do we reflect this? How do we reflect this with the journal entry? And actually, let's start with the T account. So inventory, remember inventory, we're in the merchandising context here. So you are purchasing from a wholesaler or some other supplier. You're purchasing inventory, finished goods, and you're reselling them for a profit, okay? So we said that at the beginning of the period, at the beginning of at the month or the beginning of the year, you already had $1,000 worth of inventory, okay? At some point in the period, you purchased 500, and notice it's on the left side, right? Because inventory is an asset, so I'm debiting it. And the accompanying journal entry would be debit to inventory of 500. And that's this purchase here. So this ultimately is your formula though. So if you're trying to figure out what is my cost of goods sold or what is my ending inventory, beginning inventory, if any, it might be 0, plus purchases. Did the company make inventory purchases during the year? Then they're going to have their goods available for sale. And then you're either going to be told this is how much they sold, or this is how much they had left in their inventory, their ending inventory, and then you just back in, you do the math to figure out the remaining figure, whether that's cost of goods sold, COGS, or ending inventory. So I showed both ways that there. So the journal entry, debit inventory, and credit, we said cash. The company purchased the inventory with cash. They could also have purchased it on credit, in which case the journal entry would be, the credit would be accounts payable, right? That's how you would balance that there. So we have 1,000 plus 500 goods available for sale. That's that intermediate 1,500. Now, if the business sold $1,000 worth of inventory, well, actually, you wouldn't even need to, you don't have to necessarily put parentheses here because you already know, right, because we're crediting it, that it's a subtraction figure. Okay, so 1,000 plus 500 minus 1,000 is 500. And of course, that matches the 500 we have up here for ending inventory. This is just another way to look at it. So we know at the end of the period that you have $500 in inventory. Okay, but you sold something. So how is this reflected with the journal entry? Because this journal entry shows you buying the thing first, or buying the $500 worth of inventory, and then you sold 1,000, right? Because you had 1,000 in the first place, so you were able to sell more than just what you purchased, right? Because you had that beginning balance. So I'll just mark this EB for ending balance. So the journal entry can have a debit and a credit. So what's the easy part? Where should we start? Well, we know for a fact inventory went down, right? That's this right here. It went down because we sold it. So we no longer have that inventory. Because inventory went down and inventory is an asset, we're going to credit inventory in the amount of 1,000. What's the debit? Well, I talked about cost of goods sold, this interesting new term here, COGS for short. How else would we get this journal entry to balance? Well, only by putting COGS there. COGS in the amount of 1,000. But you shouldn't be satisfied with just that. I mean, the journal entry balances, but it should make sense. What is COGS? COGS is a type of expense, okay? And as we know, you debit an expense to indicate an increase, right? And that's ultimately, that's going to be on the income statement, which as we discussed, right, the income statement, you have revenue, let's see, so how do you get net income? It's net income, it's revenue minus expenses. Net income is added to the retained earnings account. Retained earnings is what's here on the balance sheet, right? So the income statement is a different financial statement. This equation here, assets equals liabilities plus equity, represents the balance sheet, but these financial statements are connected, and this is probably the best example of that. So the income statement, IS, right? The bottom line is net income, whether you had a positive income or a negative one, right? So a profit or a loss. It comes down to revenue minus expenses. COGS is considered an expense. We debit expenses. So it lowers net income. Net income is added to retained earnings. Retained earnings, as I've talked about, is it's your summary account of net income. So over the years, right? Let's say you had net income of in your company in the past 3 years, you've had net income of 100. Well, your retained earnings account, RE, keeps track of that. So at the beginning of the new period, a retained earnings balance would be 300. And each year, whether you had a profit or a loss, it would increase or decrease that retained earnings account. Okay, so just a reminder about that, just to kind of remember the big picture, right? It all goes back, it all balances, and it all connects to this assets equals liabilities plus equity. Okay, so sorry if that was long-winded, but here you go. There's your journal entry. So you have one now for purchasing the inventory, right? This is a merchandiser. So we're not going deep into this whole, I wanted you to be exposed to this raw materials, work in process, finished goods. Those are topics that are, like I said, are discussed more in managerial accounting, but it's good to be familiar with them. If it's a manufacturer, that's what you'll see. But we're keeping it simple here. We're talking about a merchandiser who bought inventory from someone else and is now reselling it. Hopefully you notice that there's another journal entry here because, yeah, we've purchased the inventory, we've sold it, but what did we get out of this, right? Hopefully we made a profit. So let's say the inventory that we purchased for 1,000, say we sold it for 2,000. So cash goes up, and say it was on cash. It could also be accounts receivable. Someone paid us on credit. If we sold it for 2,000, the other entry here, the credit is 2,000. So assets went up by 2,000. Equity, the other side of the accounting formula, went up, right? Because just like expenses affect the income statement, which ultimately connects to equity through retained earnings, same with revenue. But of course, revenue is the opposite of expenses. You credit revenue to increase it, and you debit expenses to increase them, right? Credit revenue to increase it, debit expenses to increase them. Okay, so now you have an understanding of typically what a transaction looks like involving inventory, right? Whether you're a merchandiser or a manufacturer, it's going to look a little bit different. But you have your formula. You have your formula here. Your beginning inventory plus your purchases, your cost of goods sold. Subtracted from that is going to give you your ending inventory, which makes sense, right? You start with an amount, you get some more. You decrease it because you sold the thing, and then you're left with whatever's left. The next thing I want to talk about is a little more complicated, but it gets to, it is called, this topic, inventory systems. Okay, so there are two main systems. There is the perpetual system and the periodic system. So basically the perpetual system just says that if a business is using this system, they are keeping track of every single transaction at any given time. They know how much ending inventory they have on hand. So anytime there's a sale, right? If you purchase something, you're at the cashier, it gets scanned, their inventory goes down, right? Because they're keeping track of what they sold, and also they're able to know how much they have left overall, right? Because that cost of goods sold have been subtracted basically automatically once you've purchased that item. So that's perpetual. Periodic is almost something out of the Middle Ages, because in this system, the business does not keep an up-to-date record of inventory during the year, right? It's only at the end where employees do like an actual physical count of the goods that are left, right? And then that's how they know what's in ending inventory. Okay, so it's not really like real time. So those are the two systems. You should be familiar with them because certainly I think every accounting class talks about them. I would guess that perpetual is a lot more common, but periodic still exists, at least in some contexts. So the last thing is what's called the cost flow assumptions. So what does this mean? There's 4 different cost flow assumptions. There is specific identification. There's FIFO, which is first in, first out. There's LIFO, which is last in, first out. And then there's the average cost, or average weighted cost. So what are cost flow assumptions? The idea is that, especially in a big business, it's hard to know what costs to assign for the purposes of figuring out cost of goods sold to each individual item. Okay, so they're cost flow assumptions. For specific identification, that is sort of the ideal. Again, that's probably going to, in a big business, that's probably not happening. But with a smaller business where they can keep track, simply keep track of the actual cost of each individual item, each individual piece of inventory that was sold, specific identification works. So for example, if you had an item that was $70 to your business, it cost that, one that was 80 and another that was 100, it would be reflected as such on your actual cost of goods sold, and then it would in turn affect your ending inventory. Okay, but that's not always going to be the case. I think more common is going to be you're going to be in one of these situations: FIFO, LIFO, or average cost. So starting with FIFO. Which is first in, first out. Basically what this is saying is, again, it's a cost flow assumption. And the assumption is, going back to our merchandiser, to our retailer, right? This is why I started with this equation. Beginning inventory, purchases, cost of goods sold. The assumption under the FIFO system, if the business is using FIFO, is that the first goods that are purchased by the business are also the first ones that are sold. And so for those purposes, that's the cost that's going to be used. Okay? What does that mean? It means that this system allocates the oldest unit costs, right? So oldest because they were first, the first ones purchased. FIFO allocates the oldest unit cost to the cost of goods sold, and the newest unit costs to ending inventory. Okay, so let's see what that looks like, because it's kind of hard to kind of just hear about. So let's say that beginning inventory you had 2 units at $70 each. So this is in your inventory account. Okay, 140. Then you purchased 4 units at 80 each. So 4 times 80, 320. And then you bought something a little more expensive, 1 unit at, say, 100. Okay, that's 100. Goods available for sale, 320 plus 100 is 420, plus 140, 560. And this 560, right, is your goods available for sale. So you haven't actually sold it yet. This is just what's in your inventory account, right? So it's like this. Right, you had 140. This is the beginning balance. Then you added 320 and 100. I'll just combine those. 420. So at the intermediate stage, before you even sold anything yet, you have 560. Okay. At some point, you've sold some goods. Let's say you sold 2 units of one kind, 2 units of another kind. The question is, what cost are you going to assign to these for the purposes of cost of goods sold, right? Because something needs to go in this circle here, right? We have to credit the inventory account for it to go down. Okay, so what is that going to be? Well, if we're in a Fifo system, remember, first in, first out. The oldest unit costs are going to be assigned to cost of goods sold. Well, what are the oldest unit costs? Is it going to be, are we going to value anything here at 100? Because this unit was purchased last, so that can't be it. So if we go to the beginning, it's actually going to be this 70 first, because this is what we already had in our beginning balance. We had a unit valued at 70. So if it's first in, first out, the system is just, the assumption is that for these purposes, we're going to assign 2 units at 70. Okay, and it's 2 here, just like it's 2 here. Okay, so that makes sense. That's how you know basically how many units am I going to use at that price, right? Because you know it's going to be 70. Those are the oldest ones because they're already in the beginning balance. And the question is, how many units are we going to sell at 70? And it's going to be 2 because that's you only had 2. So hopefully that's clear. So you sold 2 at 70 for the purposes of, again, you may have sold them for more than that. I should be clear there. You may have sold them for, hopefully you did sell them for more than 70 because this, you're a business, you're trying to make money. But again, these are cost flow assumptions, and under the Fifo system, the assumption is you're going to assign the oldest costs to what you sold. Okay. So you have these 2 at 70. You still have to determine, for the purposes of determining cost of goods sold, what dollar figure is going to be here. Well, if we're just going in chronological order here, again, it's not going to be 100 because we have to deal with this 80 first, right? Because these were purchased, these 4 were purchased before that one at 100. So the answer here is just 80. Okay, so 160, and the assumption is that those are valued at 300 because, again, yes, we have specific identification, but that's really not going to work. That's really not going to work in a lot of businesses where there's a lot of product to keep track of. You're not going to look at, okay, what was actually the cost, the true cost of this item. This, you should think of FIFO and LIFO, and as we'll get to average cost, as a way of simplifying this process for businesses. Okay. So you have your cost of goods sold, right? Just like before, it lowers your ending inventory. And your ending inventory is 260. Okay, just put a ending balance there. Okay, so we have this 260 ending balance, and what I want to do here really quick is show you how you can basically check your work. So what is this 260 composed of? We started with, I'm just going to look at just the units. So we had 2 units, plus 4 is 6, plus 1 is 7, right? So we had 7 units. My gosh, sorry about the handwriting. 7 units. That did not fix it. Okay, going to erase this. 7 units. How many did we sell? We sold 4 units. Okay, so 3 units. 3 units are remaining in inventory in this hypothetical, and they're going to be valued in our inventory account at 260. But how? So remember I said that with FIFO, the oldest unit costs, right? So whether that was in the beginning balance or the purchases, those are going to be allocated to the cost of goods sold, and the newest unit costs to ending inventory. And you just have to keep track, you just have to go in order. So we exhausted these 2 here, right, for 70. We exhausted 2 of the 4 here at 80. We didn't get to the 100 yet, right? So what that means is we have 2 left at 80 to use for the purposes of assigning costs, and 1 left at 100. Well, it just so happens that 2 times 80 equals 160, and 1 times 100 equals 100, which equals 260. All right, so it works, and everything adds up. So this represents your ending balance, and you know, the newest costs, right? The newest unit costs, the ones that were added the latest through the purchases, right? The some of the 80, some at 80 and then 1 at 100, those apply to the ending balance. That's a way to check your work. So that's FIFO. LIFO is going to be just the opposite. So I'm not going to belabor this one too much because it's just the opposite, but let's go through a similar hypothetical. So LIFO is now last in, first out. It's just the opposite because now it's saying the newest unit costs are going to be used for the purposes of figuring out cost of goods sold, and the oldest unit costs are going to be assigned to ending inventory. Okay. And actually, I think I should write that down here. Yeah. So newest unit cost, that's going to be used to figure out your cost of goods sold, your COGS. Oldest unit cost is going to be used for your ending balance of inventory, right? Hopefully it's clear that the last thing that comes in is the newest, right? So if you're, if you're building a tower out of blocks, right? You stack one block on top of the other, right? This is the last one in, but it's also the newest because chronologically, right? That was the final one, okay? But last in, first out means we assume that those are going to be the first ones sold. And again, every business is going to they're going to have their own. They're going to choose whether they use LIFO or FIFO. So it just depends. Okay. So just going to run through this example. So it's crystal clear. Beginning inventory, say 2 units at 70, that's 140. 4 units at 80 is going to be first purchase. And then 1 unit at 100 is a purchase that happens afterwards. So your goods available for sale, just put an acronym there, are just the sum of this. So it's going to be 560 again. Okay. As I said before, you can either subtract ending inventory if you know it, or cost of goods sold, right? If you're looking for one number or the other. Let's say we know we know how many units were sold, so we're trying to figure out the cost of goods sold. So if you sold 3 units at 1. And 1 unit at another. We go in the exact opposite order now, right? So which cost are we going to apply? Well, we know we had a purchase of 4 at 80 and 1 at 100. Okay. So starting with, so it's last in, first out. So the newest ones are going to be applied first. Okay, well, that means we look here. Okay, so we're allowed to use 1 unit for 100. So for the purpose, if we want to assign, since 100 was the last one purchased, when we sell, it's last in, first out. So we're going to use up, think of it as an allowance, right? You're only allowed to use 1 of them. Well, that's going to be right here. And I hope the way I've set this up isn't confusing, by the way, because I've kind of broken it down here in preparation of presenting it like this. But if we just said sold 4 units, it's really the same thing, right? Because you still have to ask yourself, okay, last in, first out. So I have to start here. This was the last thing to hit our inventory. It's okay, so 1 is going to be at 100. So either way, you still break it down like this, right? I just thought I should clarify that. So 1 at 100, then we just move up, right? Because this is the opposite of FIFO. We have 4 that we can use at 80. Well, we only sold 3 units, so that's all of them are going to be at 80. 3 times 80, 240. 1 times 100, 100. Cost of goods sold is 340. Let's look at the T account. Inventory. So we started with 140, right? Then we purchased 420. The merchandiser did. You sold 4 units, and under the LIFO system, the assumption is the result is COGS valued at $340. 560 minus 340 is 220. Okay, so this is going to be your ending balance. And just as before, we can see how this 220 breaks down. So we had, let's see, 2 at 70, 4 at 81. So we had 7 units. We sold 4. So we have 3 units left over. So somehow the 3 units, the 220 should be explained by the 3 units, right? Remember I said that LIFO allocates the newest unit costs to cost of goods sold, and the oldest unit cost to ending inventory. So if we're looking at ending inventory, what are the oldest costs? Well, it starts with 70. Okay, so we're going to be able to use 2 of 70 and 1 of 80, right? Because we already used 3 out of the 4. So 2 at 70 and 1 at 80. Sorry there. 1 at 80 equals what? 2 times 70 is 140. 140 plus 80 is 220. That all checks out, as it always does. Ending balance. Okay, this is a long video. Last thing. The fourth method is your average cost. This is another way that a business can choose to value its COGS. Okay, so the idea is that I think this is simpler, because the cool thing about average cost, or it's also called weighted average cost. So that the average cost method, it uses the weighted average unit cost of the goods available for sale for both cost of goods sold and ending inventory. Okay, so as before, whether with LIFO or FIFO, cost of goods sold was going to be based on either newest or oldest, and then the ending balance would be based on the opposite, right? Whatever was left. And here it's simpler. So let me set this up for you here. So here's an example. So units, cost, and again, I imagine this would be similar to specific identification, probably in a business where you don't have as much units to keep track of. Okay, so let's say you have 2 at 70, but again, probably more cumbersome than a specific identification context, or because if you could keep track of every single one, then you wouldn't need this weighted average. So this is just sort of a compromise for the in-betweeners, for those who don't want to use LIFO over FIFO, but they can't. It doesn't make sense for them to use specific identification either. So 2 at 70, 140, 4 at 80, 320, and 1 at 100, 100, 560. Keep that there. So you just have to know this formula. So average cost equals cost of goods, not cost of goods sold, cost of goods available for sale. Right? That was that in-between figure we had after adding purchases to beginning inventory. Then you have the number of units available for sale. Okay, so cost of goods available for sale, that's going to be your total cost, if that wasn't clear. Okay, so that's just 560 divided by 7, right? 560 divided by 7 equals $80 per unit. Okay, so we're almost done. So again, beginning inventory, so you started with 2 units at 70, and 4 units that you paid 80. So 140, 320. Sorry about that. This is actually going to be purchase, as is, so just like before, as is 1 unit at 100. So the cost, so the goods available for sale, there's that phrase again, goods available for sale, right? 140 plus 320 plus 100, 560, just like before. So where it gets interesting now is your cost of goods sold are just going to be using this figure. It's very straightforward. So if you sold 4 units, there's no need to break it up to figure out which units are valued at what for the purposes of cost of goods sold. There's no need for that because you already know it's just going to be 80. So cost of goods sold is going to be 320, and that means that the ending balance of inventory is 240. Right, so 140, 420. So you started with 140, you purchased 420, you sold some units, and under this weighted average cost method, you recognize cost of goods sold of 240. Remember, cost of goods sold brings down inventory, reduces it, right? Because they're no longer in your balance sheet. Oh, I'm sorry. This should be 320. 560 minus 320 is 240. That is your ending balance. And once again, you can check your work. So you started with 7 units. You sold 4, so you have 3. And with weighted average cost, the number that you're going to use to value ending inventory is the same that you use to value cost of goods sold, unlike with LIFO and FIFO. So it's 80 again, and 80 times 3 is 240. So that was a ton of information, but hopefully now you have a good understanding of how inventory works, cost of goods sold, as well as introduction to managerial accounting. And in some later videos, I'm going to talk more about managerial accounting topics. But for now, I hope this was helpful. And if you did find this video helpful, please like and subscribe. And I'll see you soon.